Hello, good evening. My name is Ankit Sharma. I am a PhD scholar at Gujarat University. I'm doing research on non-performing assets. It is an interdisciplinary research between economics and finance. And today I'll be taking a hello, good evening. Hello, good evening. My name is Ankit Sharma. I'm a PhD scholar at Gujarat University. I'm doing research on the topic non-performing assets. And hello, good evening. My name is Ankit Sharma. I'm a PhD scholar at Gujarat University. I'm doing research on non-performing assets. It is a multidisciplinary research between finance and economics, where I'm looking at different policies of the economy. And today I'll be a faculty for this topic of macroeconomics, which is about national income and related aggregates. And since this is a sample session, we'll be going briefly through different concepts that are related to national income and a few related aggregates as well, such as the national product or the domestic product and the market price or the factor price. And we'll also be going through the net domestic product or the gross domestic product. And before talking about all of these macroeconomic terms, like such as these GDP and NDP, let us first get into the basics of economics, as in what does this term national income means, and the basic process where everything starts, the manufacturing starts, and how is this national income calculated. There are, of course, various types of methods to calculate national income. We will not be looking into these methods as of now, but yes, let us dive right into the basics of economics first. So macroeconomics, every macroeconomic concept, this gross domestic product or the gross national product, everything starts with the circular flow of income. Right now, what does the circular flow of income mean? Let us please go through this definition. Circular flow refers to the flow of money income or the flow of goods and services across different sectors of an economy in a circular flow. And so it is a continuous flow. It is a non-stop flow of different types of commodities. These commodities could be goods, these commodities could be services, and it is a continuous flow that is going on in the economy uh, in different sectors of the economy. It could be any sector, it could be within the same sector, or it could be between different types of sectors. And to understand this better, let us go through these 3 points. That is, economy is an integrated system of production, exchange, and consumption, right? So, integrated means that all these three different factors, the production, the exchange, and consumption, all three of these factors are included in the circular flow of income. So the cost and revenue that is arising from production, whatever raw materials that are being used, and whatever uh, the final product or the final
uh, in the form of consumption, as in how are these consumed by different types of consumers. And then the second point is that there is continuous buying and selling of products, right? Buying and selling never stop. It can never stop because let us understand this briefly, that if you're buying a product, right? Let us say that I bought a raw material today. The I'll be paying the shopkeeper for that amount of raw material, and in turn whatever payment that I'm paying to the shopkeeper, he or she will transfer a part of that payment to uh, the supplier of that raw material, to that shopkeeper, right? So if I'm paying someone, so if I'm paying someone, that shopkeeper will pay someone else who has given or supplied that raw material to him, and that this circle of paying back to the supplier, it never stops, right? So today I am buying, but whatever raw material, whatever product that I will manufacture using these services, using these raw materials, this selling whatever product that I've manufactured, I'll sell this product, right? So again, when I am selling, that another customer will use that product or service again in the manufacture for another product, right? So this circle of buying and selling, it never stops. It is this flow of income, it is circular, because there is no beginning or ending, right? Today I am a customer, but today I am a buyer, but tomorrow I'll be a seller. And in the same way, this buying and selling goes on not just for products, it goes on for services as well. So it is a total flow of income that is arising out of buying and selling of different types of products and different types of incomes, right? So once we have understood that the flow of income in an economy is circular, that it never stops, that it goes on, now let us continue with our topic for today, which is the national income and related aggregates, right? So, national income and these related aggregates that we'll be talking about in a little while, these are basically measures of production activity, as in how much production is going on in economy, in the at the domestic level or at the national level, and whatever production that is going on, whether it is production of goods or whether it is production of services, this production activity is measured at either the national level or either the domestic level. And even for measuring these production activity, there are different types of prices, such as the market prices or the factor prices. We'll be looking at all of this in a little detail in a little while. Now, coming back to this slide, there are two different categories of national income, two very basic categories, and these are, first of all, the domestic product and the national product, right? Now, let us understand these two categories in a little detail. First of all, the domestic product. So, production activity of all production units located within the economic territory is domestic product. Now, production activity, as in it could be manufacture or it could be production of a service, right? So, production activity that is related not just to physical goods but services also. So, production activity of all production units located within the economic territory. Now, what does the term economic territory means? It does not only mean the geographical territory. Economic territory is a territory where a certain government is ruling, right? So for India, whatever the definition for territorial waters of India is, everything is included in the economic territory. So every uh, production unit that lies within the economic territory, and whatever production activity is going on in that production unit, uh, the value, the aggregate value of all of these production activities in all of these production units in the economic territory is called the domestic product, right? So uh, to give you make you understand this in a different way, just the production activity that is going on in all the production units combined is taken together, and they are summed up, and together these values make up the domestic product value of that economy. Or it could also be calculated for a particular market as well, so not just the economy, but this is what domestic product means. Then domestic product is based on production units
That in an economic territory that is ruled by a certain government, in an economic territory, whatever production units are located and whatever the production activity that is going on in this production units uh, is called the domestic product, the aggregate value of all of these production units, right? And these production activities, these are not just operated by the residents of the country, but also the non-residents of the country. Now, the question that comes here is that if someone is a non-resident, right? If someone is not a resident of a country, then how come the production that is being done by this non-resident is included in the domestic product of my country, right? This is the question, and the answer to this is very simple. Since the production is going on in this economic territory, let us say that the production is going on in India, and if a production procedure, if a production process is going on, then it cannot happen that it is going on without the use of raw materials or without the use of uh, services, right? Something has to be used in order to produce economic value, in order to make production of goods or services. And while a certain amount of raw material or a certain amount of services are being used, these raw materials and these services ultimately belong to India, right? In the country in which the production unit is located. Now, it does not really matter if the person is a resident and or a non-resident up to a certain level, but really matters here is where the production unit is located, right? So, if it is located in India, in our country, then it could be operated either by resident or by non-resident. It does not matter, and whatever the value of the production activity is, it will be included in the domestic product of the economy, right? Now, let us first understand what national product means, and then we will look at the relationship that exists between the domestic and national product, right? So, domestic product means we have already had a look at this. Domestic product, a product is operated both by residents and non-residents, right? Both of these could have may have production units in the economic territory of the country, and whatever value is arising out of these units will be included in the calculation of domestic product, right? Now let us look at the national product. So based on the residence, yes, national product is based on the residence of the country, right? This is a distinction here, that it is based on the residents of the country and includes their contribution to production both within and outside the economic territory, right? So the major distinction here is that in the domestic product, the residents and non-residents were included, but in the national product, only the residents are included, not the non-residents. And why is that? And after that non-residents are not included, for the residents as well, it includes their contribution to production both within and outside the economic territory. Now, what does this mean? That if a resident is adding production value even outside the economic territory, even outside the economy, then even that particular production value will also be included in the calculation of national product, because this person, this a person who has this production unit, he is a resident of this country, first of all, right? And after that, he is producing something out of the country. But firstly, what matters here is that that person is a resident of the country, and because of this, whatever production is being added by him, whether within the economic territory or outside the economic territory, will be included in the calculation of national product, because that value is being added by a citizen of this country, right? So this an example of this would be, for example, if you are a citizen of India and if you uh, have some project outside India, and if you are receiving payment for it, where is the payment coming? It is coming to your account, right? And there is the account, it is in India. So somewhere India is connected in this transaction, and you are a citizen of India as well. And if the economic territory is related somehow or anyhow with this production process, with either the supply of raw materials or services in it, or either the receiving of revenue from this particular project. If any of this aspect includes connection with the territory, with the national territory, it will be included in the national product calculation, right? Now, what is the formula to calculate national product? It is the domestic product plus residents' contribution to production outside the economic territory. As in, as we looked here, that in the national product, it is based on residents and the value that they add even outside the economic territory. So this part is included in this second part, which is the domestic product plus residents' contribution to production outside the economic territory. Subtract non-residents' contribution to production inside the economic territory. Right. So in the same way that residents' contribution outside the economic territory is added, following the same logic, someone else's contribution who is not a citizen of India, who is not staying in India, whatever his contribution to production inside the economic territory is, will be subtracted. Right? It is the same logic as that of the second particular item. Right? So this is how you calculate the national product of India. And let us summarize this formula. Right. So this is the main formula, and to summarize this formula, we can say that national product is equal to domestic product of an economy plus the factor income received from abroad, subtract the factor income paid to abroad. Right. So uh, whatever production value that is being added by a resident outside the economic territory, that is the factor income received from abroad, as in you will, that person would be receiving the payment ultimately, right? And that payment would ultimately be delivered in the deposited in the bank account of this person. Uh, so this income, whatever this person is receiving, this factor income received from abroad will be added in the domestic product, and following the same logic, whatever factor income that is paid to the non-residents outside the country, any non-resident having a production unit in this particular economic territory, whatever factor income that is ultimately going to that non-resident will be subtracted. It will be deducted. Right. So the formula for national product would be domestic product plus factor income received from abroad minus factor income paid to abroad. Right. Now let us look at the relationship that exists between domestic and national product. So national product is equal to, we have looked at this formula already, that it equals to domestic product plus factor income received from abroad minus the factor income paid to abroad. Now, in order to arrive at this NFIA, which is net factor income from abroad, right? This is one of the most important aggregate of national income, right? So, in order to arrive at the national net factor income from abroad, we in the domestic product we just add the net factor income from abroad, right? This is the NFIA, and together both of these amounts will tell you what the value of NFIA is. Now let us understand what is national income. Up until now, we have discussed the very basics of economics, of macroeconomics, the uh, domestic product or the national product, and we understood briefly what these terms mean. And now that we have understood the domestic product and the national product, let us get into what does this term national income means. What is the income for a nation, for an economic territory? Right? Let us read this definition along. NI, or national income, is defined as the money value of all final goods and services, right? So not just goods, but the services as well, of all final goods and services produced within the domestic territory of a country in an accounting year, plus net factor income from abroad, right? So whatever production that has happened uh, in a particular country, in a particular economic territory, whether it be the production of a good or whether it be the production of a service, the aggregate value of all of these production values of different types of goods and different types of services, the aggregate value of all of these goods and services within the domestic territory is added in order to arrive at the national income, which is all of this production value uh, plus the net factor income from abroad, which we arrived in the previous slide here, the NFIA. Right? So in this production value, the net factor income from abroad is added, and then we arrive at the national income for any economic territory or the national income for any nation. Right? Now, let us look at the different concepts of national income. I'm sorry, this is, yes. Now, let us look at the different concepts of national income. Right. So there are these eight different types of concepts of national income, and the main distinction between them is that it is either, so there are three types of distinctions that could be there, three types of very basic distinctions, and these could be, it could either be a gross price or it could be a net price. This is the first distinction, right, between gross and net. The second distinction could be the domestic or the national, right? So all of these terms, you can see that it is either a domestic cost or a national cost. National cost, domestic, national, right? So it could either be a gross price, or gross or net, first distinction. Second is domestic and national. And the third one is it is either the market price or it is either the factor cost, right? So on the basis of these basic distinctions, there are eight different types of concepts of national income, and all of these different concepts somewhere take in account these three basic distinctions that we talked about. For example, it could either be gross domestic product at market price, or it could be gross domestic product at factor cost, uh, which is here, gross domestic product at factor cost. Then it could be gross national product at market price. Then it could be net national product at market price, which is here, right? So on the basis of these basic distinctions, there are eight different types of national income which are listed here. Now let us understood briefly the basic distinctions, what distincts these three basic values or these three basic terms. Now, this is a very basic rule which you should always remember, and which is that the difference between a gross value and a net value is always and always depreciation, right? So from the gross value, if you deduct depreciation, you will always arrive at the net value, right? So logically, what would be the formula for gross? Gross Gross's formula would be net plus depreciation, right? Because depreciation is being deducted from the gross value. In the same way, the second distinction, which is between domestic and national, right? In Right, between domestic and national. So national, since it is it is an outline, right? It is bigger than the domestic product, and in the same way, the market price and the third distinction, which is the market price and the factor cost, right? So market price is the bigger one, and uh, if you deduct subsidiaries from factor price and you add indirect taxes, you will arrive at the market price. So market price is equal to uh, factor cost plus indirect taxes minus the subsidiaries, right? So these are three basic distinctions, and on the basis of these basic distinctions, there are eight different types of concepts, which are the gross domestic product at market price. Gross domestic product is the aggregate of the production value of all the products and services in one economic territory, in one specific territory, in a given year, and this production value is calculated at market price, right? Now, this production value could also be calculated at factor cost, which is right here. So, uh, once you once you find out which type of cost that you have to calculate, so, for example, you have to calculate the gross domestic product. Then the next question that comes is, if you have to calculate it at market price or the factor cost, then accordingly there will be a certain change in the type of formula that is being used, right? So since we know that market price is equal to the factor cost plus the indirect taxes and minus the subsidiaries. So in order to arrive at gross domestic product at market price, we could even take the gross domestic product at factor cost and then add in the indirect taxes and subtract the subsidiaries, right? So in this way, uh, according to these three basic distinctions, any type of cost on the national level could be computed. Now, the another one is gross national product at market price, right? So, what is the different thing here? Uh, it is a gross value. This was also a gross value. It is at the market price. It is also at the market price. But the main distinction here is that it is on the national level, but this one is on the domestic level. Now, what is the basic distinction that we talked about between national and domestic? It is that national consists of domestic cost plus net factor income from abroad, right? So from this value, if you already know the GDP at market price, which is GDP at MP, you could simply add the net factor income from abroad, and whatever the value that you would come at would be the gross national product at market price, right? So just these three basic distinctions are different, and if you understand the basic distinction between these terms, between gross and net, between national and domestic, between market price and factor cost, right? If you understand the basic terminology, what these terms mean, it would be very easy for you to understand these different terms. These may look complicated, but it is not the case. You just have to understand the basic terminologies. So, to give you another example, let us look at the net national product at market price, right? Now, the term here, first of all, is net. So what does this mean? That it does not include any depreciation, right? So if you already have a certain values that are given in any question, right? So you will not include depreciation. This is the first clue. Then let us go to the second term. It is net national product at market price. So after net, when we know that depreciation will not be included, let us go to the next term, which is national, right? So here, what will be included? The domestic prices, the production value of all the goods and services at the national at the in the economic territory of that country, plus the net factor income from abroad, right? So first of all, depreciation will not be included, and second of all, the production value of all the goods and services in the economic territory, and in this value, what will be included? Net factor income from abroad, right? This is our second thing. And now let us look at, okay, now we know that we have to calculate the net national product. Now the question that again comes here is whether it has to be calculated on the market price or the factor cost. Now here we know that it has to be calculated on the market price. Now what does market price again mean? Market price means factor cost, add the indirect taxes, and subtract the subsidiaries, right? So from the question that would be given, we will to arrive at this value, we will not consider depreciation. We will consider production value of all goods and services in the economic territory, and add net factor income from abroad, NFIA, and then we will take the factor cost, and we will add the indirect taxes, and we will not include the subsidiaries. And that is all. You just have to understand these three basic terminologies, these three basic distinctions, and then all of these concepts of national income, all of these eight concepts of national income will become very clear to you. Now, please understand that there are different formulas to calculate all these eight different types of concepts, and the meaning, the ultimate meaning of all of these concepts are is different, because there are different terminologies in each of the formulas, right? Now, because this is a sample session, we will not be going into much detail about their meaning and the formulas that are used to calculate them. But to give you a basic framework of how national income at various costs and at various prices, at various levels, whether it is national or domestic, or whether it is gross or net, is calculated, please understand this, that first of all, the value of output is calculated, right? It could be an output of services, it could be an output of goods, and whatever the value of output is and whatever the value that they have been sold at, we will add the change in stock, right? Whatever the change in stock has come, and if there is any intermediate consumption or not, right? So just to arrive at the final sales value, the final revenue, right? And once you know the final revenue, it will be the market price, right? Because it is being sold right now to individuals. It will be the market price. And since it is the value of output that are being sold in the market, it is GDP at MP, right? Because it is what is gross domestic product. It is the value of all the goods and services that are being sold at the domestic level, right? So it would be gross domestic product at market price. Whatever the value of output is, which is being sold in the market. And from this value, which value? The GDP at MP, the gross domestic product at market price, this first concept, right? And from this particular value, if we deduct depreciation, right? If you are deducting depreciation, which terminology depreciation comes in? The gross and net terminology, right? So if from the GDP at MP you deduct depreciation, what will you arrive at? You will arrive at the net domestic product at market price. So just the first term will change because you are deducting depreciation, right? And once you come at the NDP at MP, which is here, once you come at the NDP at MP, you will deduct, if you deduct the net indirect taxes, right? Just the indirect taxes, not the subsidiaries are not included here. So if you where does the distinction between indirect taxes and subsidiaries come? We know that it comes in the terminology of market price and factor cost, right? So from the GDP at MP, we deducted depreciation, we got the NDP at MP, and from this value, we are deducting the net indirect taxes, and because of this, the market price will be changed to factor cost now, right? Because we have deducted the indirect taxes. So from this value, we have this, and now we have the net domestic product at factor cost. And here, if you add the net factor income from abroad, now where does this value, in which of the terminologies does this value come? We know that it comes in the domestic and national terminology, right? So if you add NFIA, the net factor income from abroad, to the domestic value, what you will get is the national value. So if you, it in the NDP at FC, if you add the NFIA, what will you get would be the net national product at factor cost, right? So this was just an example to make you understand how the different types of calculations are done in order to arrive at different concepts of national income, values of national income according to different concepts, right? So and this was just a brief understanding of national income and some of its aggregates, and we will stop our session here, and I hope to see you in one of the live classes, right? Thank you very much, and I hope you understood the concepts clearly.